What if you could sort of peek under the hood of a major pet retailer like Petco? Really get a sense of how their business is doing.
Yeah, well, today that's exactly what we're going to do.
We're diving into their Q4 and full year 2024 earnings. They just came out March 26, 2025.
Exactly. And we've sifted through the official earnings presentation and the release to pull out the really crucial bits for you.
Right.
The idea is to give you a clear picture of their financial performance without you having to wade through like pages and pages of reports.
So our mission today really is to understand Petco's recent financial health.
Yeah.
And what are their plans? What are they expecting for the year ahead? And whether you're into the whole retail sector or maybe specifically the pet industry or even just tracking big company performance, this should be pretty interesting for you.
Absolutely. And just so we're clear, the sources are Petco's fourth quarter and full year 2024 earnings call presentation and their official earnings release. That's what we're digging into.
Okay, let's do it. So Q4 2024 first. What's the top line look like?
Okay, so net revenue for Q4 was $1.6 billion.
Which sounds like a drop.
It is, yeah. It's down 7.3% compared to Q4 of 2023. But, and this is a big but, you got to remember that Q4 the year before had an extra week. It was 14 weeks versus 13 weeks this time around.
Ah, right, that calendar quirk. So it's not quite a fair comparison just looking at that number.
Exactly. That's why looking at comparable sales is probably more useful here.
And how did those look?
Interestingly, comparable sales actually increased by 0.5%.
Okay, so comparable sales.
Yeah.
Just remind us what that covers again.
Sure, it basically looks at the revenue from stores that have been open for at least a year. So it filters out the noise from, new stores opening, stores closing, and importantly, like we just said, that extra week effect.
Gotcha. So it gives a cleaner view of the trend in their established business. A slight uptick there.
A slight uptick, yes.
Yeah, what about profit for the quarter?
Well, gross profit was down a bit, 2.8% to $589.3 million.
Yeah.
But their GAAP net loss actually got better.
Better how? Still a loss. Still a loss, yeah, but smaller. $13.8 million loss compared to a $22.6 million loss in Q4 the previous year. So they lost less money.
Okay, less red ink is definitely better than more. I also saw they mentioned adjusted EBITDA. What's the story there?
Right, adjusted EBITDA. It stands for earnings before interest, taxes, depreciation, and amortization with, well, some adjustments made by the company.
It's one of those non-GAAP things, right? Not standard accounting.
Exactly. Companies use it to try and show their core operating performance, stripping out financing costs, taxes, and things like depreciation, which aren't cash expenses.
So how did Petco do on that measure in Q4?
It came in at $96.1 million. Now, that was actually ahead of their own forecast, which is good.
Okay.
But it was still down from the $105.3 million they did in Q4 of 2023. So core operating profit, by this measure at least, was a bit weaker year over year.
Okay. So Q4, revenue down, but maybe not as bad as it looks because of the weak comparison. Comp slightly up, net loss smaller, but adjusted EBITDA down.
Got it. Let's zoom out then. The full year 2024.
All right, full year. Net revenue was $6.1 billion. That's a decrease of 2.2% compared to the full year 2023.
And again, we have to remember 2023 had 53 weeks, right? Not just 52.
Precisely. That extra week impacts the full year comparison too. And similar to Q4, the full year comparable sales were also slightly positive, up 0.3% for the whole year.
Okay. And the bottom line, the net loss for the full year.
This is where it gets kind of dramatic. The GAAP net loss was $101.8 million.
Which is still a loss, but...
But compare that to 2023. They lost $1.3 billion then.
Whoa. Okay, what happened there? How did it improve so much?
The main reason, the overwhelming reason, was a massive charge they took in 2023. A $1.2 billion non-cash goodwill impairment charge.
Goodwill impairment. That's like writing down the value of something intangible on their books.
Exactly. They basically said some part of their business wasn't worth what they had it valued at on paper. So they took that huge write-down in 23, which made their loss look enormous. Without that, the comparison would be, well, very different.
So stripping out that huge one-off charge from last year, 2024 looks much more stable financially speaking.
Yeah, you could say that. Though adjusted EBITDA for the full year was still down. It came in at $336.5 million compared to $401.1 million the year before.
And cash flow, how did that look?
Operating cash flow also jipped, $177.7 million, down from $215.7 million. But here's a really positive point.
Okay.
Free cash flow. It swung from negative $9.9 million in 2023 to positive $49.7 million in 2024.
Wow. Okay. From burning cash to generating almost $50 million in free cash, that sounds significant.
It really is. Free cash flow, it's the cash left over after they pay for operations and invest in things like stores and equipment.
The cash they can actually use for, like, paying down debt or investing more or maybe even dividends down the line.
Precisely. So having positive free cash flow is a very healthy sign. Shows they generated more cash than they used in their core business and investments.
That is a definite positive. Did they mention anything about their physical stores, like openings or closing?
Yeah, they did. Over the full year, they closed a net of 25 pet care centers.
Closing stores, so maybe trimming the fleet a bit, focusing on the better locations?
Could be. It might be part of a strategy to, optimize their physical presence, especially given how shopping habits are changing.
That makes sense. So big picture for the year. Revenue slightly down, comps slightly up, net loss way better, but mostly due to that old charge. Adjusted EBITDA down, but free cash flow turned nicely positive, and fewer stores.
That sums it up pretty well.
Okay, let's drill down into where that $6.1 billion in revenue actually came from. How did the different categories perform? Let's start with Q4 again.
All right, Q4 categories. Services and other revenue. So think grooming, vet care, training, that kind of stuff. It was down 5% compared to last year's Q4.
Okay, down 5%.
But here's the interesting part. If you look at it on a 2-year basis, so comparing to Q4 2 years ago, it's actually up strongly, 13% growth.
So maybe some short-term softness, but the longer trend in services is still quite positive.
Seems that way. Services are often seen as stickier, less vulnerable to online competition, maybe.
Right. You can't get your dog groomed on Amazon. What about the stuff they sell? Food, treats.
That's consumables. That revenue was down 6% year over year in Q4. But again, looking over 2 years, it was actually up 3%. And they specifically mentioned continued strength in fresh and frozen pet foods.
Okay, so essentials like food holding up better over the medium term, even with a quarterly dip. What about the fun stuff? Toys, beds, leashes.
That's where the weakness really shows. They call it supplies and companion animal revenue, basically the discretionary stuff. That category was down 10% year over year in Q4.
Ouch.
And it was down 11% even looking back over 2 years. So that's a clear area where consumers are pulling back.
Yeah, you can definitely see the split there between needs and wants. Can you give us the actual dollar figures for Q4?
Sure. Q4 2024, consumables were $781.2 million. Supplies and companion animals, $529.0 million. And services and other, $241.9 million.
Okay. And obviously, those are all down a bit from the prior year's Q4 figures you mentioned earlier.
Correct.
So let's see how those trends played out over the entire year. Full year 2024 category breakdown.
Consumables for the full year were $3.04 billion. That was down just 1% year over year.
Okay, almost flat.
But look longer term, up 6% over 2 years, and up a pretty solid 19% over 3 years. So that demand for food and treats is resilient.
Seems like it. What about the discretionary side for the full year?
Supplies and companion animals.
Yeah.
That was $2.07 billion for the year, down 6% year over year, down 13% compared to 2 years ago, and down a really significant 22% compared to 3 years ago.
Wow, 22% drop over 3 years. That really shows a sustained pullback in that area.
It really does. It's not just a blip.
And services. How did that key growth area do for the full year?
Services and other revenue hit $999.6 million, just shy of $1 billion. That was actually up 2% year over year.
Okay, positive growth there.
And the longer view is impressive, up 24% over 2 years, and up a huge 44% over 3 years.
44% growth over 3 years for services. That's clearly a major bright spot and strategic focus for them, isn't it?
Absolutely. It underscores just how important that side of the business has become. It's buffering the weakness in the discretionary product sales.
Definitely looks that way. So given all this, the performance, the category shifts, what are Petco's main takeaways? And what are they telling us about the future?
Well, according to their reports, they feel the Q4 results show they're making tangible progress in getting the core retail operations stronger.
Okay.
They talk about building momentum heading into 2025, and the focus seems to be on, well, merchandising, improving the customer experience both in stores and online, and just being more efficient overall, cutting costs, basically.
Did they mention anything about management?
Yeah, they highlighted that they've now got their full senior leadership team in place, pulled in people with experience from other parts of retail.
Yeah.
They seem to think this new team is key.
And strategically, where's the effort going?
It sounds like it's really back to basics, financially speaking. They want to expand gross margins, get a better handle on their SG&A.
Selling general and administrative costs, like overheads?
Exactly. Control those costs better. And ultimately, they're prioritizing return on invested capital ROIC, getting more bang for their buck from the money they invest in the business.
Makes sense. So what are they actually forecasting for 2025? You mentioned they sounded optimistic.
They did. The headline is they're projecting double-digit adjusted EBITDA growth in 2025.
Double-digit growth. That's quite a forecast after the decline we just saw.
It is ambitious, yeah. They gave specific guidance, too. For the full year 2025, they expect net revenue to actually be down low single digits compared to 2024.
Huh? So revenue down, but EBITDA up significantly. How does that work? Margin expansion and cost cuts.
That seems to be the plan. They're forecasting adjusted EBITDA between $375 million and $390 million. It's a big jump from the $336.5 million in 2024.
Okay. What else did they guide on?
Net interest expense around $130 million. Capital spending, so investments in stores and tech, between $130 and $140 million. Depreciation and amortization around $200 million.
And store count? Are they closing more?
Yes, they expect to close a net of 20 to 30 more stores during 2025, continuing that optimization trend we talked about.
And what about the very near term? Any guidance for Q1?
Yeah, for Q1 2025, they're also expecting net revenue to be down low single digits year over year, and adjusted EBITDA projected between $82 million and $83 million.
So the CEO, Joel Anderson, must be feeling pretty confident about this plan.
He certainly projected confidence in the release, expressed strong belief in the new leadership team to deliver that improved EBITDA this year and really set them up for sustainable, profitable growth down the road.
Okay. Now, before we wrap this up, you mentioned things like adjusted EBITDA and free cash flow are non-GAAP measures. Can you just quickly clarify again what that means for listeners?
Sure. Non-GAAP just means it's not calculated using the standard official accounting rules, generally accepted accounting principles.
Okay.
Companies use these extra measures, like adjusted EBITDA or free cash flow, because they think it gives investors maybe a clearer or different view of their performance. Like adjusted EBITDA tries to show core operational profitability without financing or tax effects.
And free cash flow shows cash generation ability.
Exactly. And they also mention net debt, which is another non-GAAP one, basically total debt minus their cash. It's a way management presents the figures to highlight what they see as core performance or financial health.
Got it. And speaking of debt, did they give a number on their leverage?
They did. They mentioned their net debt to adjusted EBITDA ratio was 4.2 times as of the end of the fiscal year, February 1st, 2025.
And how does that compare?
It's up slightly. It was 3.7 times the year before. So their debt level relative to their adjusted earnings has increased a bit.
Okay, thanks. That gives a really comprehensive picture. So if we were to boil it all down.
Yeah, summarizing. Petco had, let's say, some positive signs in Q4 24. Comparable sales were up slightly, the net loss shrank.
Yeah. But overall revenue is down for the quarter in the year, partly due to that extra week in 23, but also definitely because people are spending less on those non-essential pet items.
Right. The discretionary stuff is clearly hurting. But their focus on essentials, food and treats, and especially on services, seems to be the core strategy now.
And combining that with cost control, that's how they're aiming for that big jump in adjusted EBITDA they're forecasting for 2025.
That looks like the plan. Drive growth in services, maintain a consumables base, manage margins, and cut costs to boost profitability, even if the top-line revenue isn't growing much right now.
Which leads us to maybe a final thought for you listening.
Yeah, think about this. With this clear shift, we're seeing consumers focusing on pet essentials and services, cutting back on the extras. How do traditional retailers like Petco need to keep evolving?
I mean, what else might they need to do with their business model to really thrive long-term, not just survive in this changing landscape?
It's definitely worth thinking about the broader pet industry trends and, how the economy continues to shape the way we all spend money on our pets.